Joining us now to talk about the U.S. economy and the markets is John Herrmann, Director of U.S. Strategies at Mitsubishi UFJ Securities, and David Nelson, Chief Strategist at Belpointe. Good to have you back on the show, gentlemen.
Thank you. Great to be here.
John, I'm going to start with you.
Okay.
So 5.9% unemployment rate looks good on the surface, but we look at the labor participation rate, which is at a three-decade low, and hourly wages are also flat. So taking all of these data points into consideration, what's the job picture like overall, in your opinion?
Okay, so what I think we've been telling you along the way for the last couple of years is that what we're seeing is a decent cyclical ramp in jobs, and we're getting a good cyclical recovery. We do have some structural issues with the labor market. For example, the aging of the population. We also have longer-term unemployed who have troubles with their skill sets. So, but in general, I think the economy is really getting, stronger. And what I think is, to tie in with the markets, we have a really interesting divergence between the U.S. performance and, say, the Eurozone, which really has much more structural issues.
The U.S. is probably the cleanest shirt and the dirtiest hamper, as some would say. David, you think there's some flies in the ointment here?
I think he hit on a very important point, the secular issues. This has been going on for a couple of decades. We've been exporting jobs for almost 2-3 decades now, and the truth is that big muscle jobs go to where big muscle jobs are cheap, and that's just not simply here. And as far as the markets are concerned, we're the lifeboat. We're the lifeboat. There are very few asset classes out there that are working. Everybody's coming here, and this is part of the resurgence in the U.S. dollar.
We're the lifeboat, and that is, as you quite correctly say, is pushing the dollar up. So what does that mean for the jobs market?
I don't know what it means. I'm not quite sure what it means for the jobs market. I can tell you what it means for the stock market. It means that portfolio managers have to start to rethink how they've invested assets. Obviously, things like energy and commodities are going to be hard hit by a rising dollar. My biggest concern is for large cap multinationals, because we've been pushing a lot of effort into the emerging markets. Those are our customers. And a rising dollar makes U.S. goods less competitive.
Well, let me put a little bit of back. So I'm a fixed income guy. So from our standpoint, what we've seen, the U.S., we've grown our budget deficit pretty dramatically over the last, 4 or 5 years. And so there were some concerns about, how high would yields potentially back up to basically have investors hold our debt and so on. But what we're finding now is when you look at the differences globally, the labor markets in Germany and many places in Europe will closely resemble that in Japan, which means they have an extremely flat, low yield curve. And what it's doing is, I just met with some of our Japanese clients today. They're looking at the global interest rate picture and they're saying, we'd like to buy U.S. yields, and so our yields aren't quite backing up. So they're actually helping us to fund our deficit cheaply. So it's almost like a virtual. It's a very weird.
Let's bring it back to the U.S. markets. They did rally today, though. For the last month, it's been a bit of a tough one. The S&P down 1.7%, the Nasdaq down 2.7%.
Well, we had that line in the sand, and I've written about that. The line in the sand for the S&P was the 120-day moving average. We breached that on Thursday, but we closed well above it, and
Break it down to me. Are the fundamentals in the U.S. economy that we've seen with this jobs report, with consumer confidence numbers, with U.S. trade deficit?
It supports a higher stock market, yes.
It supports a higher stock market.
In my forecast, we're looking for payrolls next 2 months in a row to be around 250 to 260,000. We're looking for a much better Christmas holiday shopping season this year than previous years. Next year, we're looking for the unemployment rate to drop a full 1 percentage point. Part of it's structural decline. The other part is job creation. So we're getting this thing moving.
He's right. We have some areas of this country that are just booming in jobs.
We saw GDP revised, second quarter 4.6%.
That's right. And the 248 actually masked
Are we seeing this translated into corporate earnings? Are we seeing growth on the top line, revenue and sales?
We are, but I do have a concern. I want to see what the reports are like next week. I want to see what they're saying about this rising dollar, these large cap stocks. The energy complex is where the boom is right now. And the fact that the United States is well on its way to a path to energy independence has enormous, implications for what we're going to pay for U.S. assets.
I think in terms of the dollars, one interesting example just came out this past week. We saw 4 motor companies say, okay, we're selling a tremendous number of vehicles in the United States, but yet our sales in Europe, they're taking over $1 billion hit in their operations in Europe. So you're really getting this divergence.
Europe is the
global.
trouble spot.
It's absolutely the trouble
That's really
spot.
the trouble spot.
Europe is a trouble spot. We know what the ECB is doing with regards to rates.
They're trying, but even
And
Mario
nothing
Draghi,
came out of Draghi this week. Nothing.
I know, but Mario Draghi was very straight-faced and very direct, saying, you know, there's a limit to how powerful the monetary transmission mechanism will be in Europe.
Let's bring it back
here.
to Janet Yellen and her monetary policy, and everybody's now watching what the Fed would do.
You've got a war going on there. I mean, there's obviously a huge debate within the Fed. You know, you have a Placer and a Fisher on one side of the table, and Janet Yellen, who's, you know, obviously been very dovish and given out mixed signals in here. I think what we need to look for this month is really the key. I want to see a change in the language, because we can't have a change in policy until we change the language.
Yeah, but it's going to be too soon to change. I think it's going to be a little bit too soon to change the language, because you basically always want to.
Well, if you change the language, then 6 months later you can get the Fed hype, because if they don't change now, then we're going to look.
So we want to build in more expectation.
You can easily do it, and you can easily do it in January.
Right now, the markets are expecting a rate hike, safe to say, second half of 2015, and they're mentally preparing for that. Is that still on target?
I think that's very reasonable, because as I said to you, the unemployment rate, our target is by mid-year next year, we should be at around 5.3% June, which is the Fed's long-term goal. So we'll be at that going lower.
Don't you think 5.3% unemployment rate, it really masks a lot of other problems that we have here.
David,
with a job participation rate this low, what does it really mean?
What it means is we have 4 million job openings right now, and we need to. What it tells us, and you're not filling in with domestic talent.
Gentlemen, we're going to have to wrap it up. David, very quickly, do you see the Fed raising rates second half of 2015 or sooner?
Certainly by then, absolutely.
All right. Well, thank you very much. Nice, heated, lively debate. John Herrmann, Director of U.S. Strategies at Mitsubishi UFJ Securities, and David Nelson, Chief Strategist at Belpointe.